Let's bring in Girish Pai, Head of Research with the Nirmal Bang Institutional Equities. He's joining us right now. Girish, good morning. Good to have you here. Let's just begin very quickly with what your thoughts are on HDFC Bank and the exit of Mr. Sukthanka. The call this morning from Mr. Puri. As always, characteristically confident about prospects for the bank and saying no real impact on business, etc. It's all in a way taken care of. That's the message from Mr. Puri. But your sense from an investor point of view?
Yeah, so it's a small wrinkle right now. I think HDFC Bank has got a fairly deep management bench, and I think the exit of Mr. Sukthanka is probably going to have a small negative impact in the short term. But beyond that, if you take a medium to longer term perspective, I think the company is well placed to benefit from the credit growth that's going to happen in the Indian economy. And I think once the economy picks up to 7.5 to 8% number, I think the credit growth will probably accelerate from here. So I think we have a buy on the stock with a target price of 2,500, and we stick to that despite whatever has happened recently in the bank.
Oh, okay. So no impact there, but in terms of a pecking order within the corporate banking space or the private financial space, what would it be, Girish?
Yeah, so from a tactical standpoint, we like corporate banks right now. While there is a structural play from the private retail-focused banks like HDFC, IndusInd, etc. From a near-term standpoint, we think that there is a fairly larger upside in the corporate banks, and we are talking specifically of private corporate banks. We're talking about ICICI Bank and Axis Bank right now, more so ICICI Bank, because I think a lot of the worries on the asset quality side are largely behind us. I think most of them have been recognized and largely provided for as of first quarter of FY19. From here on, I think the accretion is going to be fairly minimal. The other thing that one needs to take into cognizance is the fact that the book of ICICI Bank has turned retail. So almost like 57–60% of the loan book of ICICI Bank is retail as we speak. Plus, there's a fair bit of value coming from the subsidiaries, which are into asset management, life insurance, general insurance and stuff. And these are leaders in their businesses. So to that extent, we like ICICI Bank quite a lot. We have a target price of about 415 right now. So within the pecking order from a 6 to 12-month perspective, we would probably want to pick ICICI Bank and then go down to maybe look at the structural plays like HDFC and HDFC Bank and IndusInd Bank.
Girish, that's on the banking space. One stock I wanted to ask you about is Tata Motors. I mean, there's a report which says that the valuations or the cheap multiples seem to be just a value trap. And that has been the argument for many people to actually accumulate Tata Motors or recommend it as well. What's your sense, considering the kind of weakness and continuous kind of weakness that we've seen, say, in terms of the fundamentals as well as reflecting on the stock price?
Tata Motors is not under our official coverage right now, but I think the big problem with Tata Motors is that a large part of its profits comes from JLR, which seems to be facing weak sales growth globally, particularly in China. So to that extent, I mean, I wouldn't be able to give a specific comment on it, but within the large cap auto space, we like Maruti as well as Eicher Motors, and within the two, we like Eicher Motors a little bit more. So Maruti, it's a case of a company gaining market share with regular introductions of new products. So we think that situation is going to continue even going forward. I think between the two, that is between Eicher and Maruti, we like Eicher a little bit more because we think that over the next 3 to 5 year time frame, we think that Eicher's volume growth is going to be a tad faster than Maruti's. We think that it's going to gain market share within the overall motorcycle space. Currently, it's got a motorcycle market share of about 5 to 6%. But one should look, if you look at a geographic standpoint, in the more prosperous states like Punjab, Kerala or Goa, almost 1 in 3 motorcycles sold are from Eicher. Whereas if you look at the poorer states, I mean the states which are lower rung, say UP or Bihar, you have just the market share there at about 1 or 2%. So I think my sense is that as India becomes more prosperous, my sense is that the motorcycle buyers will gravitate towards the Eicher products, and that will mean that you will actually see market share gain driven growth in Eicher. So we are expecting a low teen to high teen kind of, mid-teen kind of growth come through for Eicher in the medium term, which should be better than that of Maruti's over that particular time frame. So while we like both companies, we would kind of rather bet on Eicher Motors at this point in time.
Girish, just wanted your feedback from all your conversations with the buy side. I mean, what is the mood out there really like? I mean, are people excited, saying, well, growth is picking up, earnings revival is on track, a lot more opportunities will come our way? Or there is a sense of skepticism with regards to the very high valuations, especially in large caps?
So I think the problem that the domestic fund managers face is that they are getting in money, and it's a question of how do they allocate that capital within the set of stocks that they have, the stock they're supposed to consider. Now with the reclassification that has been ordered by SEBI, you have a situation where within the top 100 market cap companies, you need to fill your portfolio, especially the large cap funds, those companies. So right now the hunt that most of these fund managers are on is with respect to where can you get the best returns within these large cap companies. So it's more of a process of finding where the maximum return can be generated. So I think that is the a view that we have coming out of the buy side right now. It's more, I think the situation vis-a-vis flows still remains fairly good. We still have about $1 billion of SIP flows coming through on a monthly basis, which is obviously there is an issue with lump sum amounts not being up to what the numbers were, say, in November, December, January of last year as well as this year. But I think the SIP flows are still fairly strong, and when you compare that with what we had, say, 2 years back, the situation still looks good. So even now, as we speak, it's still a situation where fund managers are looking for good ideas to invest in.
Okay, all right, we're going to leave it on that note. Thanks very much for joining in, Girish, and talking to us and taking us through all of your strategies and thoughts on the fundamental space for the markets. For the Bank Nifty, still weak, down over 300 odd points at this point in time. The Nifty also sulking, down over 60 odd points. We'll take a break, but up next.